And joining us now here on Market Talk as we wrap up the week of trade, let's say good afternoon to our good friend Ted Seifried with Zaner Ag Hedge. Ted, what's going on, man? Good to have you back on the show.
Yeah, not much, Jesse. Great to be back. Thanks for having me, man.
Yeah, I appreciate the time as always. Ted, I was trying to figure out how I was going to steer our conversation to start today because there's a lot going on in the market trade. To me, though, the market's set up right now heading into the weekend. It just kind of feels like this continued push pull between the macro side and everything going on there and then the weather market. Would you say that's a fair assessment of what's going on? It's just kind of this back and forth, this tug of war going on right now.
Yeah, absolutely, Jesse. I mean, you look back on the last 4 weeks, and you can really say that there have been times in most of those that last 4 weeks where we've not really been trading grain fundamentals. Go back to the acreage report. You had, I think, the most bullish soybean acreage report we've ever seen, possibly one of the most bullish soybean reports we've ever seen. Just period, right? Uh, and yet, less than 24 hours later, we were $1.07 lower than where we were trading 30 seconds after that report came out. In fact, it's one of those reports where if you'd have told me what that report said before the rest of the market got it, I'd say, wow, that might be a limit up report. That might actually be a limit up a day or two, a couple of days. If that report happened last year, oh boy, wow, then you are talking $20 beans. But this is a much different climate, and I think that has to be our biggest takeaway here from the last 2 weeks. Uh, this past Sunday night, you had probably the scariest pollination forecast, corn pollination forecast that we've seen since 2012, and we were flying Sunday night. But by the end of the day, Monday, we were only up 4 or 5 cents. That's telling you that we're not really trading weather. And then the report that we had this Tuesday, it really wasn't that bearish. Yeah, our carryover numbers came in a little bit higher than expected, well within the range of guesses though. And actually, the math that the USDA did on the soybean balance sheet, I kind of walked away from that feeling pretty bullish about soybeans because the USDA had this sort of rip the band-aid off mentality on demand, cutting 65 million bushels of export demand, even with a record amount of new crop sales on the books, and cut the crush 10 million bushels. So you figure, well, that's probably all the heavy lifting they can do on the demand side for now. If we're not at that 51 and a half national average yield, let's say we cut a bushel off that. That takes us right down to 150 million bushel carryover. That's really tight. Cut a bushel and a half off that. We're down to 110 million bushel. Oh boy, this might be the most bullish soybean balance sheet that we've seen since the start of this rally 2.5 years ago. Yet here we are, sharply off the highs, well over $2 off the highs now. So that tells you there's more going on, Jesse, and you got to take notice of that. I've been talking about for months, how inflation affects these markets, and for the past 2 years, we've been not really having to talk about it because it's been going the same direction as grain fundamentals, and so corn and beans have been going higher with this inflationary undercurrent helping that out. And looking back, you say, well, hey, if I had, and I think I've said this on your podcast before, if I was Rip Van Ted and I fell asleep for 10 years and you I woke up and you handed me a corn balance sheet, I'd say, hey, 1.4, 1.5 billion bushel carryover, that's pretty friendly, pretty tight stocks to usage. I'd say that's 550 to 6.25 corn. But then you tell me we're 750, $8, I'd say, whoa, where did that come from? Well, that's that inflationary undercurrent, that's been part of our markets this entire way. So now, for the fact that that's coming out, well, then we're like, well, what is this? Well, okay, it's been there and it's been to our advantage. We have to realize that is a double-edged sword, and we're seeing the other side of it right now. The big question is why? Why are they getting out of their inflationary hedges? Why are they so negative on commodities right now? Especially when you saw a 9.1% consumer price index (CPI), and 11.2 producer price index (PPI),
Mhm.
which is really, I mean, wow, that's a lot of inflation. Those are the highest numbers we've seen since 1981, over 40 years. So why are they getting out of inflationary hedges? Well, my best answer to that, Jesse, is that we trade futures. We don't trade today's. And while we are seeing lots of signs of inflation today, these guys, the big money, the Wall Street, whatever, they don't see inflation being as strong or being as much of a thing in the future. So they want out of their future hedges, their inflationary hedges that they have in the futures market, right? And why don't they see the inflation in the future? Well, for a couple reasons. One, CPI, PPI, those numbers are really backward looking. They're reflective because it takes a while for lower input prices to translate into lower prices to the producer, but even more so to the consumer. So really, what are those numbers going to look like in a month or two? And when you look at a lot of commodities and energies, a lot of things down like 40% off their highs, you say ultimately that those numbers, those inflationary numbers, are going to come down because of lower input costs. So that's part of their thinking. The other one is the Fed. The Fed has blood in its eyes and is coming out with haymakers, right? It's been berated in the news media. Many people have really gone as far to say this is the most incompetent Fed that we've ever had in the history of the Fed. And there's kind of reasons to say that. They should have been raising rates back in October, November last year. They waited too long, and then when they did start raising rates, they felt like they had to catch up and they had to prove something. And I still think they feel that way. And unfortunately, with those really strong CPI and PPI numbers and good jobs numbers, I think they not only justified, but they feel like they have to raise at least 3/4, not maybe a point in this next round, which comes at the end of the month, which I don't think they should. I think now would be a very good time for them to take pause. I would leave, at the most, I'd go a 1/4 point, but if I'm the Fed, I leave it alone for this month and see what CPI and PPI do in the next 2 months. And I want to see what July's is and what August is before I really make any strong conclusions.
Sure.
And I don't need them to come back to normal levels. I just need to see them trending in the right direction. If I see that, I'm thinking that maybe the increase that we've had in rates for now is good, or just token 1/4 point moves, things like that. But the Fed needs to realize, everybody needs to realize that this inflation wasn't caused by an overcooked commodity or overcooked market economy. We weren't in a bad place before the pandemic, but we weren't really super hot and heavy. It's not, go back to 2007 when we had multiple bubbles kind of all over the place as far as, housing market bubble, subprime market bubble, tech bubble. We had a lot of things going on. The big bubble that we had this time around happened after the pandemic started and after the stimulus money came in, which again, this inflation was really caused by the stimulus money that we pumped in during the pandemic. But part of that stimulus money, it seems, went to cryptocurrency, and that's the bubble, and that's something that we've talked about the last few times we've talked. There's been a tremendous amount of wealth destruction that has occurred in the cryptocurrency market. You go back to mid-November of last year, and the overall market cap of all the cryptocurrencies combined was just under $3 trillion. Now it's about 960 billion. So we've lost more than $2 trillion, just poof into thin air in the cryptocurrency market cap. That takes away a big chunk of the stimulus that had been put into the market. Then you look at the stock market down 20+% since the beginning of the year, erasing all of 2021's gains. That's a big wealth destruction event. So all the stimulus and the money that pumped into the market to create the inflation has been offset by a lot of these massive losses that you see in the cryptocurrency and in stock markets and things like that, which is why I really think the Fed needs to be careful here and not be out for blood and feel like they have to prove a point. And I really hope they take pause and look at what the whole root of this inflation was and how that's really changed here over the past 6 months or so. But yeah, I mean, to your point, a very long-winded answer for you, Jesse. Yes. We hadn't really been focused on grain fundamentals. There's a lot of people, analysts, farmers, people, your normal agricultural market participants that have been very frustrated with how these markets have been acting in the face of some really fairly bullish fundamentals. And now that it seems that this inflation off selling may have taken a bit of a pause, uh, unfortunately kind of coincides with maybe a little bit less threatening weather. Some pretty decent pop-up rains. I mean, a very large area of rain on Friday that had fairly low confidence. I mean, so somewhat of a surprise for the amount of rain. And granted, a lot of places just got a quarter an inch to half an inch, and sure we could use more. But man, it really feels like a lot of these low percentage chance rain events have actually been happening. It's sharp reversal to what it was like in June, where we had high percentage chances that just didn't happen. We missed out on a lot. So it does feel a lot like the weather patterns changed, and you feel like maybe these forecasts are trending weather, and you worry that maybe last Sunday night was our sort of peak weather concern as far as the forecast was looking into corn pollination. I think soybeans still have a big question mark for August. The longer term forecasts are still a bit scary, but unfortunately, I don't think we were trading grain fundamentals at the time where the grain fundamentals were the most bullish. And now that we're back to being able to trade fundamentals of these individual markets, I'm not sure we have quite the same bullish enthusiasm that we did. So it seems like that was a missed opportunity there to some extent. And I understand the frustration of a lot of people. So I don't know. We'll have to see where we go from here. But the message has been very sharply put out there for us, and that we have to be protecting our downside here. This is a much different year than what we've seen in the past couple of years. This isn't last July where we were, okay, we'll sell cash, but we'll re-own with calls because there's, a tremendous amount of potential, and inflation is still building, growing, strong. There's really not a whole lot of downside potential. There isn't going to be this demand rationing because of inflation. Well, you take that inflation away and you look at the prices we're at, you realize that, oh boy, here comes the demand rationing. And the last time we were up at these or better price levels when we didn't have that very strong inflationary undercurrent was 2012. And we know what happened there. We took 4 or 5 years to come back and buy that demand back. Hopefully that's not the scenario we're looking at here going forward.
Well, Ted, shifting gears a little bit, you talked quite a bit about the monetary side there and stimulus, and we're hearing about stimulus in China now. And
Yeah.
I bring up China because obviously very important on the export front. Weekly export sales this week were pretty dismal for quarter beans. We did get a corn sale this morning, though, to China, which was a little bit surprising. But I think about that Chinese economy and the impact it has on our exports,
Mm.
and you look back to the USDA report as well, cutting some of that soybean imports for China. I just wonder how that dynamic could shape up here as well in our markets over the next couple of months.
Yeah. So that is the hope, Jesse, is that one, hopefully this is in 2008. And I think there's a lot of reasons why we should think it's not. And two, we're hoping that the Chinese stimulating their economy does good things for the global economy, but in particular, it's exciting for the grains because, hey, maybe that means more exports for us. But what I will say about that is that for as late as our Fed was for raising rates, I mean, they took too long. They should have been doing it back in October, November. You can say the opposite about China. They waited too long to add the stimulus, right? This should have been happening when they were going through their big lockdowns, and it was really putting a lot of pressure on their economy because now you've got a whole lot of Chinese citizens that aren't paying their rents, that aren't paying their mortgages. There's some bad stuff going on there, and the stimulus that they are putting in is sort of a last ditch effort to try to save that. I don't know if it works. It might be too little, too late. But if it does help anything, grain should be the beneficiary. To your point, though, I mean, we really have not seen good export sales lately. We desperately need to see that pick up. Hopefully, the USDA is wrong about lowering next year's export sales on the balance sheet. But until we see the proof in the pudding, Jesse, it's really hard to say that those sales are going to be there going forward.
Well, I know as well. We were talking about this before we went on the air. The July contracts going off the board. We continue to watch cash basis here in the U.S. remain pretty stout, pretty strong, despite the market sell-off. And it feels like it's a couple different camps here. We have some producers who forward contracted, and they're worried about this what this weather situation is going to look like here. They're worried that they may be oversold some of their new crop And then you have some folks holding on to old crops still. And part of the reason why we saw, July corn holding such a premium, and to me, there's a couple different things going on with the cash trade, old crop and new crop, but there's a lot going on there as well right now, Ted, in the grains.
Yeah, and I think that's one of the reasons why we don't feel like this is 2008, or at least one of the reasons why I don't think this is 2008 is because that cash market has stayed really rather strong. And as far as the guys that are worried that they may have oversold, i.e., a lot of my guys in the Dakotas, um, well, they're feeling a lot better about that now. If prices are much lower. They might get saved on that, and they might just get let out of those contracts, or be able to fill them later at a later date. But the big one that you mentioned is, I just don't understand who's still sitting on old crop cash, because the market structure is just screaming that you need to move that old crop. That July contract held on to strength basically to the very end, and carried what, a dollar 25 premium over the September. Man, sell the cash, come in and buy September calls, and then you have no risk to the downside. And if the September gets up to the price levels that the July did, well, then you're going to make more money on the calls even. So, yeah, wow, it was just screaming at you, make the sales. But now look, September is really losing ground to the December. So, September, which is kind of, I don't know if I should use this word on there, but bastard, which I mean that because it's sort of a fatherless contract. It doesn't really know if it's old crop or new crop. So it's kind of hard to make these comparisons a little bit. But that Sep-D spread is basically back to even. In a year where we have tight old crop stocks, that September should take on more of an old crop stance and really have a nice solid premium over the December. And it's not doing that. So it's saying that the cash market is loosening up, and that a lot of bushels had come out, with that strength that we had in July. If you're still sitting on old crop, I mean, I think the longer you wait, the more risk that you're really putting yourself in, unnecessarily, really.
Ted, we should talk a little bit in the livestock trade as well, wrapping up the week. Any thoughts on this protein sector? I know weekly export sales were pretty dismal for both beef and pork, but I mean, we've seen good strength in the hog market. We've seen cattle try to come around, especially the feeder market. What are your thoughts on the protein sector this week?
We had a real nice breakout to the upside in feeder cattle earlier in the week, and that kind of coincided with a whole lot of pressure that we were seeing in the corn market on Tuesday, and then kind of fell flat there Thursday and Friday. It really wasn't able to continue to follow through the upside, and we kind of returned back to the scene of the crime. What was resistance is now acting as support. So that's a bit disappointing. Cattle kind of doing the same. They didn't quite have the same breakout that feeders did, but we're at the higher end of the range at least. It kind of fell flat there Thursday and Friday. And part of that was the export sales number, marketing your low. Don't like seeing that. But also, you saw a big turn there on Thursday with the stock market under quite a bit of pressure. So now we're back to worrying, are people going to want to spend money on high priced beef if their 401ks are getting shellacked? Uh, we kind of been going back and forth with, hey, crude oil and unleaded gasoline are down, so maybe we can spend more at the grocer. But then we look over the stocks and we say, oh, well, maybe we won't spend any money because we're worried, or maybe we don't have it. So there is that sort of constant push and pull on the demand side, or what we think is going to be there for demand for beef going forward. I will say all the heat that we've got in the plains, though, we've got weights that are already below the 5-year average. That's certainly not going to help. But on the other side of that, you've got guys that are coming to market sooner because the pasture's not there. Feedstocks are still, even though authorized, they're still really expensive. So up front, you're going to have a fair amount of product coming to market, I think, but that's going to leave you with sort of a vacuum for animals later on. The question is, will that demand be there or not? So, yeah, we're stuck in a range for cattle, kind of, and it's because we've got this sort of push pull uncertainty about what's going on going forward. The hogs, I really like the hog trade, because if we are headed to this recession, and if the stock market continues to go under pressure and people are tightening their belts and not spending as much money, you still have really relatively high priced beef, but then you look at the cuts next to it, the pork chops and shoulders, really very reasonable comparatively speaking. And so you wonder, is pork going to be the recessionary trade? Is that something that will actually build a fair amount of demand if we do continue to see an advance towards a recession, right? So I don't know. Although I don't know if there's a whole lot of fundamental reason to be super bullish on hogs right here. Again, like you said, exports were really not great. I mean, they weren't a marketing year low like cattle were, but they were well off of what we had been seeing. China wasn't in there. Domestic demand has been solid, but not amazing yet. But again, you wonder if some of the speculative crowd are kind of thinking, hey, if we are headed to recession, we look for ways to capitalize on that. And you wonder if pork's maybe getting some attention for that. I think it should.
Well, Ted, before we run out of time, real quick, any final thoughts you want to share with us on this Friday?
Something we didn't touch base on was energies, right? And there's a lot of reasons why I think energy should be coming down. We are, well off our highs, but we talk about the inventory buildup that's happening in a lot of the major retailers, Kohl's, Home Depot, Target, Walmart, things like that. And what does that mean? If they have burdensome inventories, meaning they've got a lot of product in store, they're not having to bring new stuff in. What does that mean? That means less truck traffic. That means less diesel demand. We just saw that people are choosing to drive less. Unleaded gasoline demand down 12.4% year over year. And by the way, last year, this time, we weren't completely open, especially in a lot of the blue states. So this year should have been way above. Demand should have been much higher, but it's not because of the pricing. So you're seeing that demand destruction happening for various reasons in the energies market. And that had been one of the things that had been kind of propping commodities up as a whole, even though we had been seeing a lot of this inflation off selling. If crude really accelerates to the downside more so than it has, I think you really have to get a little bit worried about commodities as a whole, where grains might be going. And I'd like to say that this inflation selling is subsided and we have a chance to bounce here. But again, watch that crude oil market. If it really starts to fall apart, I think that's the canary in the coal mine.
Well, Ted, great stuff as always. And I know if folks need some advice, they can reach out to you and the team there at Zaner Ag Hedge very easily. How can they do that?
Yeah, my direct line is 312-277-0113. You can also find us on the web at www.zaner, that's zaner.com. You can read a bit about us. You can also sign up for our morning Ag Hedge newsletter, which is a newsletter, not a recommendations letter. The recommendations come from us, and they're tailor-made to our clients individually. And if you're on Twitter, I'm at the Ted Spread. Been talking a lot about cars and ethanol lately.
Yeah, all sorts of the fun stuff on Twitter. And of course, we appreciate the time as always, sir. Have a great weekend, and we'll talk to you again soon.
My pleasure, Jesse. You have a wonderful weekend as well, and we will talk to you again soon, man. Look forward to it.
Ted Seifried with Zaner Ag Hedge joining us today on Market Talk. That's going to do it for the show. Find us, markettalkag.com. I'm Jesse Allen. Have a great weekend.